So today is the first time we have the lecture, which is the economics lecture, the EUI economics lecture, and also Pierre Werner chair lecture. So it's the first time we have it in Zoom, but that allows to have Laura as welcome as it was foreseen to have, just giving the lecture. Of course, it's a pity it's not here, although today was raining a little, so it's not the best day. So, but in any case, you gain a bonus to come anytime that when we are out of lockdowns and these things, so you have a trip, okay? And then you see other parts of Florence and the EUI. So we are very pleased to have Laura. I mean, Laura is very special. I mean, she got the PhD in 2001 from Stanford before she was at Northwestern. And since then has been in New York, basically. First, most in NYU, Stern, where I met her many times, and now in Colombia. She's working, as you might know, on issues on information and economics and finance, has exactly a book, Princeton University Press, on just this, on information in economics and finance. And it is a really impressive CV. Just to give you an idea, you can see it also in the web, but so this is what I see in her CV. Just right now, it's just waiting because it has this 1, 2, 3. So has these 5 papers forthcoming, and actually 2 in GPE, 1 in the American Economic Review, and 1 in Restat, and 1 in the Journal of International Economics. I don't think many people are waiting to have 5 papers just published now on these journals. So that gives you an idea of her productivity. Of course, there are all the ones that they've been before, but mostly is that she's actually working in an area which I think it's now extremely important, because it's about information and data, but in combination on finance and macro. So I don't want to take more of her time. So Laura, the floor is yours. And then, as we said, we're going to have some questions at the end.
Thank you, Ramon. That was a very generous introduction. So what I'd like to talk to you about today is a growth model of the data economy. And this is joint work with Mariam Farboudi, who's at MIT Sloan. And basically our question is, this looks more like the modern economy than many of our traditional macroeconomics models that take capital and labor and combine them and produce, some physical good that we might call a widget or something like that. And instead, the largest companies in the economy are taking data and producing some data services. And so given that more and more value is produced looking something like this rather than our traditional economy, we want to gain some understanding of how does this economy work. So first, I want to convince you that the economics of data is largely the economics of prediction. So the top 5 most valuable US economies are data intensive. And I think a lot of the reason that people are interested in this recently is the improvements in artificial intelligence and machine learning. So I'll call those AI, ML. And I really mean a whole suite of technologies that draw on large quantities of data, that larger than what we were able to handle before, right? So this data was already out there, but we didn't capture it, we didn't value it, we didn't try to store it and organize it very much because, hey, it was hard to use that much data. We've all gotten to the point on an Excel spreadsheet where we've run out of space or tried to download something into, MATLAB and had it crash because it's too much. And so, recent innovations have made getting just, terabytes and terabytes of data and using it productively possible. So, but then that leads you to ask, well, what are these new technologies? And at their heart, artificial intelligence, machine learning, and the suite of big data technologies recently invented are prediction technologies. They are about identifying, is this picture a cat? Is this music by Bach? Is this, does this look like this class of objects? That's the essence of these. Now we could use predictions for lots of different things, but they're prediction technologies. And yes, there's some data, like we digitize patents, right? So there is some data that are truly innovations, but that's not really what the big data revolution is about. Big data is largely statistics. The bulk of it is statistics and in particular, records of transactions. So we're going to write a theory that focuses on that type of data because it's economically important. It's not all of data, right? Data can be music digitized, it can be patents digitized, it can be poetry digitized, but that's not what we think is the most economically important. So we're going to look at this kind of data.
What about data that's used, for example, for autonomous vehicles and other autonomous technologies? That seems to be a major use of data these days.
Right. So a lot of that is also prediction technology. What is the probability that what you're about to hit is a pedestrian? What is the probability that I'm going to have a collision with an oncoming, what is the probability that that object is a stop sign, right? So a lot of those are prediction technology.
Well, a lot of things are predictions, but I'm not sure how helpful that is. So for example, the reason that SpaceX is able to re-land rockets is because the artificial intelligence of the boosters enables them to predict where the landing site is going to be. But this, everything's prediction, right?
Great. So we're on the same page. Now I'll try to convince you why that's important.
But everything was prediction before this too. I don't see what changed. We're just better at it now. That's all.
The whole world is about prediction. We're great. We're off to the races. I just want to convince you that the prediction is an important part of what the modern economy is doing with data. If you thought it was already doing that, fine, no problem. We just got, maybe we got better at it. So I want to, there are a lot of questions that you could ask of a data economy. And I want to start with a simple starting point, which is to basically do the Solow 1956 exercise, which he did with capital accumulation, but do with data accumulation. So that means I want to start by asking the question, can data accumulation alone sustain aggregate growth? So in doing that, I'm going to hold technology fixed. Now, I understand fully that data is an input into technology production and that predicting things can help us advance the set of ideas that we have. But in the same vein, we use labs and other forms of capital to advance idea production as well. So I want to set that stuff aside and say that's not what I'm interested in. I want to hold that fixed for the time being, not because that's the real world, but because this is a laboratory to explore ideas, and isolate some basic forces of accumulating data itself. And I'm going to show you that with a very simple model of accumulating data that's being used for forecasting, for prediction, that there's going to be a force of decreasing returns, a force of increasing returns, and some returns to specialization that arise. And then once we understand that, we can go back and layer all kinds of other realistic features on top of such a model that might help us to quantify it, that might help us to think about policy and so forth. But I want to do a really basic thought exercise, which is let's shut down technology and just accumulate data. Okay, so I'm going to construct a recursive framework with data accumulation. Data comes from transactions, right? So I said a lot of data is the byproduct of economic activity, is records of transactions. So when we do transactions, when we sell stuff, it will generate data as a byproduct. And there's going to be a changing world. And that's going to be important because it makes old data depreciate. Okay? So the data that I got a week ago is about the state of the world a week ago, and that's less relevant for today than data accumulated today or acquired today. And then we'll explore three key ideas. First is data cannot sustain long-run growth without technological progress. So in that sense, it's going to be like capital, and that's because of decreasing returns. But there's also going to be a form of data poverty traps that emerge. So new firms dropped in an environment where there are other firms in steady state will face initial losses. And that's because there's a form of increasing returns going on here. And third, we'll think about the question of who becomes a data seller and what do returns to specialization look like in the setting. So I'm drawing on a whole bunch of ideas.
I'm just puzzled about the data aspect of this, because if I replace in your first two bullet points, if I replace the word data with investment, it would be equally true and make equally as good sense.
Okay, so
what's special about the word data?
I think part of what I'm trying to convince you is that the data economy is not a new economy.
Okay.
That has a lot of features of the old economy.
Then we're definitely on the same page. Okay.
There are going to be some little twists and turns that are different. The way it's produced is different.
That I can believe.
Right? But yeah. Okay. So, but I think there is something surprising about that, because I don't think most people came at this saying, hey, the data is just like capital, like the data economy is just like the old economy. And so I want to show you the extent to which that is true. Okay, so three key features of our model, each drawn from a different literature. So data enhances productivity. It's non-rival, so you can use a data set and I can use a data set, and we don't interfere physically. It might be less profitable if we both use it. And it's got returns to scale, meaning I can apply data to a small firm, I can apply the same piece of data to a big firm, and it might have more effect on the total output of the big firm. And these are ideas that are present in growth models, so like Jones and Tinetti, and Agarwal and Liu, Aghion. These guys have been writing growth models, but it's one where data is productivity, right? So data translates linearly into a unit of something that looks like TFP. And I'm going to argue that that's not quite right, that we want to think about data as being information that's used for prediction. So the difference between data and ideas is new data techniques or prediction techniques. And so Pat Bajari is now the chief economist at Amazon, writes about exactly how they're using this and the kind of diminishing returns that set in the context of that particular firm. But at the same time, data is a byproduct of economic activity. So this is kind of like learning by doing. It's also similar to the kind of work that I did in my job market paper. Guillermo Ordóñez or Fagelbaum, Schall, and Taschereau Dumochel have in their models where a unit of production generates information as a byproduct. But what's new here is a few things. There's going to be persistent common uncertainty that's going to make data depreciate. We're also going to have data that's a tradable, long-lived asset. Okay? So drawing different pieces from different literatures.
Sorry.
Yeah.
Ask one single question. I mean, maybe it's too obvious. So from what I understand, the real value of the data is the information that it conveys.
Yes.
And that's how you're comparing it with capital, right?
That's how. I think that the fact that it's like capital is going to be result, and I haven't shown you that result yet. So far, that's just a preview and an assertion. But you're right that I'm thinking, the difference in how I'm thinking about data and how the previous macroeconomists who've written on this topic are thinking about data is I'm taking seriously the fact that it's information. It's information being used for prediction. It is not a piece of data that says that I bought blue socks yesterday for $6 on Amazon. That's not TFP. That's something different.
So exactly as you said. So my question is that then not increase like data. So if you have like one more unit of capital, it's actually one more unit of capital, but one more unit of data necessarily doesn't mean one more unit of information.
That's right.
So then in this sense, I mean,
okay, so let's see the model and then we'll come back to that.
Okay, sure.
Okay, so we've got a continuum of competitive firms I. So let me start by saying this first line is the assumption I like least about this, and I'll come back to all kinds of reasons why I think we want to move on to thinking about firms with some market power in this setting. But in the spirit of let's do a solo 56 kind of exercise for data, let's keep it simple and start with competition. Each firm produces K firm I times T to the alpha units of goods with KIT units of capital. These goods have quality, AIT, and I'll tell you what quality is in just a second. And then they're going to take, there's nothing interesting going on with the demand side of this economy. So I'm just going to roll it in. I'm going to give you the result right up front, which is bad form, but we'll simplify the rest of the discussion. They're going to take their equilibrium prices given. That's what it means to be competitive. And their quality adjusted outputs are perfect substitutes. So what that gives us is that the price at time T is a parameter P bar. It's the aggregate output to the negative gamma. So the more output, the lower the price. Aggregate output means we're integrating over all firms I of the quality adjusted units. So AIT, KIT to the alpha, that's units times quality to the DI. Okay, so we're going to have a really simple downward sloping relationship between number of units and price. So I want to just roll that into the background. Here's where all the action is. It's in what is this quality? So quality depends on a chosen production technique. And each firm has an optimal technique. So A is a choice variable. Theta plus epsilon is a random variable that they'd like to forecast. There's a forecastable piece or a learnable component, theta, and there's an unlearnable component, epsilon A. Theta is an AR1 process with an innovation eta IT, and it's normal with mean mu and variance sigma theta squared. This piece, and I'll show you why this is important, is unlearnable. It's normal, it's mean zero. If it had some other mean, we'd learn it. and variance sigma A squared. And that's IID. So the productivity or the quality of my good, we're going to write as A hat minus, this is a squared forecast error. So you're going to want to choose a production technique that's as close to the optimal technique as you can, right? Because you'd like to bring these two closer. The best you can ever do is make this 0. And so you're going to choose a production technique that's close to theta plus epsilon. And so you're going to lose the difference between those two. And the way I think about this, I think there are a number of interpretations of this. One is this is a capital allocation problem. I'm trying to figure out, is my blue sock factory or my red shirt factory likely to be more profitable tomorrow? Where would I like to direct my productive capital? We could think about this as identifying customers. What should I try to sell to invest capital to market to you? And you might value one good relative to another. It could be, exactly how should I produce this car? Do we like it, in this sort of style or something else? And depending on my choices, it's going to have more value. But we're basically trying to solve some kind of prediction problem that could have to do with operations. It could have to do with marketing. It could have to do with product selection. So then what data is it's going to help us solve this problem, make this difference smaller. So data is about period t+1 is a byproduct of period t production. So I have my pictures in the way. Let me put those up. So the number of data points that I get at time t depends on the number of units I produce, k to the alpha. Okay, that's my number of units of production. And then there's this parameter, which is data mining ability. So if you want, you can think of that as something that makes some firms' data more accurate than others. Okay, this could represent more precision units per unit of data. Or you could think of this as, the corner store, which uses an old-fashioned cash register, just doesn't keep any of its data as records. They don't do anything with it. And so they have a very low Z, whereas Amazon records everything that I click on, everything I think about clicking on, that my cursor hovers over, and everything. And so they're very data savvy. They have a high data mining ability. So this is a number of data points you get. What is a data point? A data point is a piece of information, S, which is theta. It's that learnable component of the optimal technique with some signal noise. Okay? So we can't have it at each point perfectly reveal theta. We want it to be an imperfect realization of that state theta that you're trying to learn about. And so that signal noise is normal 0 sigma epsilon squared. So what happens is the more data points you get, or the more precision data points you get, you're going to get more signals. And you're going to have a bundle of these. You're going to use them to forecast theta. You can't forecast this piece, so you're just your expectation of that will always be 0. And when you can forecast theta better, you can bring your production technique closer to the optimal technique and thereby produce higher quality goods. Okay, so that's going to be the essence of what data does. Okay, so embedded in here is a form of what people have called the data feedback loop. So especially people who've written in the microeconomics of data use this phrase, and what they're talking about is that let's take a firm that's a bigger firm. It's got more transactions, more customers, more production. That firm generates more data. And so with more data, they can thereby engage in a higher quality or efficiency of production, right? This could be better capital allocation. It could be better marketing. It could be, actually producing goods that people like better. But when you produce stuff more efficiently, you can produce, higher quality goods at a lower price. You're going to have more transactions and more customers because you're more competitive, which gets you more data. Okay, so this is in the model here. More data depends on how much you're producing. Okay, and that more data will allow you to forecast theta better, which gets you a higher productivity. And higher productivity will induce you to choose a higher K, a higher investment, because if you're more productive firm, you're going to want to invest more. And that will then generate you more data and so forth. Okay, so I just want to point out that idea that's present in the micro data literature is present in this model. Okay, so then the other piece that's important is that data can be bought and sold, right? That's not a piece of this story. This story kind of pretends like a firm keeps all of its data and it can't buy anything, it can't sell anything, it's a closed loop. But in fact, this is kind of an open loop system. And so we're going to think about delta as being an amount of data traded by firm I at time t. So data positive will represent data purchases, delta negative will represent data sales. And we're going to impose that a firm can buy or sell, but they can't do both, at least not in a given period. They can buy today and sell tomorrow. And there's a data price pi t that clears the data market. Okay, so we'd like to introduce the idea of there being some non-rival data. So you can sell your data, but that doesn't mean you have to give it up, right? It's not a pen. If I sell you my pencil, can you see my pencil here? I can't also use this pencil. Either I own it or you own it. I can sell you my data and we can both, go use it happily. Now, that's a tricky thing to introduce because it raises the question, why isn't all data sold, right? If I could sell everything and I get a positive profit for it and I get to keep it all too, and we have a competitive market so that nothing I do affects any equilibrium price, I'm just going to sell everything and there'll be no existence of equilibrium here. So what we need to do is impose that a fraction of sold, we need to impose some costs. There are different ways to do this. So like Jones and Tonetti do this by saying, the more of your data you sell, there's this higher probability you're just going to get zapped and go out of business. Okay? We're going to do it a little bit differently in a way that's more tractable for our model, but it's got a similar flavor, which is a fraction of the sold data is lost. Now, we don't really think that you just drop it or lose it, but we think of this as maybe being market power. So if I sell you my data, it's less valuable to me. So I don't actually lose it, but it's not as profitable. It can also represent privacy restrictions that say one person can act on this data and can make use of it, but you can't have multiple users of this data because that violates the agreements. Okay, so it could be regulatory or market power, but that's sort of our way of building in some kind of imperfect competition in a model that's otherwise perfectly competitive. It's imperfect, but doing something else is going to impose a lot of other costs in terms of complication in the model. So then there's a data adjustment cost. So just like we put capital adjustment costs to prevent immediate convergence in models of firm dynamics with capital accumulation, we're going to put in a data adjustment cost of exactly the same variety flavor. Okay, so that's the setup of the model. So now we're going to talk about a solution. So we need a recursive problem to characterize the solution to this problem because one of the things you ask is, well, how much should I produce? Well, when I produce, I think about how much data will that generate, but that data is not just useful for me right now, it's useful for me in the future because I get to bring that data forward and it's going to help me solve future forecasting problems as well. So we've got this stock that has a long-lived value. So the first thing we need to do to solve any recursive problem is to define a state variable. So anybody who's learned from Tom Sargent has probably heard the phrase that finding the state variable in a problem is an art. So here's, this is art, we just made one up, okay? But it's one that's useful. So here's the state variable we're gonna use. It's the posterior precision of the forecast about theta. So we're gonna call this thing omega. We're gonna label it the stock of knowledge. Let me start in this expression on the inside. So here's your data, that's your information set. That's where you put all that data you've produced or purchased. You're gonna use it to form an expectation about theta. Right? So a conditional expectation is a forecast. The difference between that expectation and the realization of theta, that's a forecast error. This is a squared forecast error. And the expected squared forecast error is what we'd call a conditional variance. Okay? So it's how far do you expect your forecast to be from the truth in squared distance terms. And then finally, we're going to take that conditional variance and we're going to invert it to make it a conditional precision, the precision being the inverse of the variance. You don't have to do that. You could define a state variable that's a conditional variance. The reason we like this is that this has a flavor that more knowledge, more precision is more data, right? So it just kind of has the right directionality, but whether it's precision or variance doesn't matter technically for the problem. So then this thing's useful because we can take the state variable and now we can express the expected quality of firm I's good at time t as being a hat minus the conditional variance of theta. And then this is the conditional variance of the expectation about A, but because I know nothing about it, that's also the unconditional variance of A. I can't learn anything about it.
To ask a brief technical question.
Yes, please.
So the outer expectation, the unconditional expectation, that is the unconditional expectation of the precision. Is that correct?
It's the expected squared forecast error.
No, it's the outer one, the unconditional expectation. There's two, conditional expectation on the inside. There's
Yeah,
an
this one's-
unconditional expectation outside. I'm just trying to understand where the inverse operation occurs, before or after you take the outer expectation.
After you take the outer expectation.
Okay, that's not clear. You better put some more parentheses in there, because that's what it says. It says first you compute the precision, then you take the unconditional expectation. That's what the equation says.
This
That's
second
what
one, this is a conditional expectation. This is a conditioning bar.
No, that's the issue, is not that. Within the square brackets, there is this thing. According to the formula, you take the thing inside the square brackets, you invert it, and then you take the expectation. That's what it says. I believe what you mean is you take the expectation and then you invert it.
Yeah, you take the
Yeah,
expectation.
but you put more parentheses in so that it's clear that the expectation is taken right before the inversion rather than after the inversion, because it's written, it's wrong, and it's confusing.
Sorry. If I had the touch screen, I'd take my pen and do.
Yeah, I understand it, but it would really be helpful to have an extra set of parentheses there.
Okay, yes, this is definitely take the expectation and invert it. This is a conditional variance, 1 over the conditional variance. Okay, so now we can express expected quality in terms of our state variable. And now we can write the optimal sequence of capital investment choices solves the following recursive problem. The value of a stock of knowledge, so this is a standard value equation, like this is going to be a Bellman equation, is max. You're going to choose K, and you're going to choose this capital, and you're going to choose your purchases or sales of data. Okay, and then I'm already embedding in here that the optimal A, if you remember, you're choosing this production technique. The optimal A is the conditional expectation of theta. Okay, I'm solving that out, and that's already going to be embedded in this problem. So if you choose your optimal production technique, then your expected quality will be this. Okay, so we have price times expected quality times units, that's your K to the alpha, minus, this is your data adjustment function, data adjustment cost. This is the amount of data that you bought or sold. If you sold, delta is negative, and this is plus some revenue, minus the rental rate on capital, and this is the discount rate times tomorrow's value of tomorrow's data. Okay, so that all looks just like what we do for capital. What's a little bit different is the evolution of the state variable omega. So remember that the number of data points you get is your data mining ability times K to the alpha. And then the evolution of this equation is basically given by a Kalman filter, right? Because what we're doing is we're saying, how precise is my information tomorrow if I had this precision today, this inverse variance today, and this is the new data points that I've added to my stock of knowledge. This is N, the stuff that I produced. This is my data sales or purchases, and that's the precision of each of those data points. So this is the total amount of precision I dropped in because of the new data I got today. This is about how we discount old data. So why do we discount old data? The reason we discount it is that theta is an AR1 process, okay? And the reason that that's important is it means that yesterday's data was about yesterday's theta. The state theta today is different from what it was yesterday. So yesterday's data is less relevant than today's data. So we got to discount it accordingly. So how do we discount it? It depends on what is the persistence of the AR1 process. That's that rho squared. So the more persistent is the AR1 process, the more relevant the data about yesterday's state is about today's state. And it depends on the innovation variance in the AR1 process. If they're big innovations, then yesterday's data is less relevant for today's state. This sigma A is in there because there's an additional thing you learn, which is you get to see your own output. And by seeing your own output, you learn something about your own productivity, your own good quality, which is an additional piece of information that we have to add on to your stock of knowledge yesterday that you get to see at the end of the period. So this is all of your knowledge at the end of time t. This is how we discount knowledge. And this is the new data that you're adding into your stock of knowledge because of new data points you've observed. Okay, so that's how we can write this as a standard sort of Bellman equation, but there are some differences about this being information. We don't just have 1 minus delta times your old information stock. Instead, we think about discounting is determined by the volatility and the persistence of the environment that we're in. Okay, so now I'm going to show you some results from this. Before we do that, I just want to point out that there's some data accounting going on here. V of omega, that's this value function, is the value of firm I's data, right? And so now we have some tools to think about how do we value data that offers a stream of prediction services into the future. And one could think about enriching and quantifying this model to try to back out that data. Similarly, V prime of omega is your willingness to pay for an additional unit of data today. That's your marginal value of data, which also could be mapped into things like data prices if we can see some data transactions. And finally, omega t, this stock of knowledge, is really like a discounted sum of data investments, right? Here's my new investment, here's my discounted stock of past data, and here's my new stock of data. So the forms look a little different, but this is very much like how we accumulate capital and discount it going forward. Okay, so now I'm going to show you 3 forces at work. One is diminishing returns. That's going to get us long run stagnation. So data accumulation alone won't allow you to grow forever. The second is increasing returns. We'll talk about data barter. A lot of data is being is being transacted at zero price, and data poverty traps. And finally, we'll talk about big firms and data specialization. Okay, so anybody who's ever taught a macro class has probably drawn some version of this graph. And it was for the solo model, but it turns out it looks really similar for the data model. So we're going to talk about inflows and outflows of data. So the inflows are these new data points you get to see. So that's your data savvy. So now let me be clear. I'm talking about this at the aggregate level. So I'm setting aside whether we buy or sell data. I'm just thinking about the total amount produced in the economy. So that's the data savviness, K to the alpha, the number of units we produce, and the precision of that data. That's our inflow, and that's what's in the red line here. And then outflow is data depreciation. So this is not actually a linear function, but it turns out that it looks pretty close to linear, where we see some nonlinearities sometimes are down around here, okay? But when we plotted it for the parameter values that seemed in the ballpark, we got something that looked pretty linear. But what's key is it's not concave, right? We can get some convexity in there, but this function is always concave. And so we're going to, have a growth period here where inflows exceed outflows, and this economy is going to accumulate data. And then we're going to grow to some point that's a steady state where the inflows and outflows become equal and growth stops. So the first thing I want to talk about is an abstract economy and ask about the prospect of diminishing returns. And because I think one thing that you might, reasonably point out is that there are a couple of sources of diminishing returns. There's the fact that K to the alpha. So if more data induces you to invest more, more investment has diminishing returns. And that's true. But even if I were to set alpha to 1, I would still have diminishing returns in this economy. And the reason for that has to do with how we formulated quality. So notice that quality has an upper bound, okay? And so what's happening is that you can get better and better at forecasting, but the best you can ever do is to set precision to infinity, which means you set variance to 0, right? And so one of the things that encapsulates is that when you think about forecast errors or forecast variance has a natural lower bound. You can't set variances lower than 0. But you could argue we could have formulated this as like 1 over, the variance, and had this thing go off to infinity. So, there is some amount of baking in of the diminishing returns that's going on here. So before I go on with this model, let me tell you about how we might think about this, the general principles of where diminishing returns might come from. So let's think about an arbitrary model where data is used to forecast, and this affects output in some way, okay? And then let me put down a couple of premises. Data accumulation can only sustain a growth rate GT that is in every period above some lower bound G lower bar if 2 things hold. First, perfect forecasts would need to generate infinite real output, right? And the argument here is really simple. We can't keep growing at some positive rate. I should have said G bar is greater than 0. We can't keep going at some positive rate if there's a finite upper bound, right? Because we're going to cross it. So we'd have to have an infinite upper bound. So the first thing you'd need to not have diminishing returns from data accumulation alone is you would need that somehow being able to forecast tomorrow perfectly means that I can generate infinite real output. Now, if I could forecast tomorrow perfectly, me and only me, I could become exceedingly rich, right? I could go gamble on the stock market, make a bunch of money, but that's a separate proposition from saying the economy as a whole could generate real wealth without bound, okay? So if you think that's true, fine, but I just want to point out, if you don't believe in diminishing returns, that's the first thing you buy into. And then there's a second one. The second thing is you also have to buy into the idea that the future has to be deterministic, okay? So, I'm not a philosopher and I don't know about, universal determinism more than the next person, but you would have to buy into that. And the reason is, to get infinite output, we need infinite precision, right? We're going to have to get to zero variance forecast. We're not going to get infinite output with finite precision for any finite valued mapping. And zero variance forecasts are only possible if tomorrow is a deterministic function of today's information. If tomorrow is not a deterministic function of today's information, then it is not measurable. I can't predict it perfectly. And so perfect predictions, getting to perfect predictions sort of implies that tomorrow must be knowable and therefore must be a deterministic function of today. So, I can't prove that the future is not deterministic. I'm not sure anybody can, but those are the kinds of things you need to buy into. And that, to me, that's sort of a stretch of an imagination. So this to give you a sense of why do we make these kinds of assumptions that we do in the setup of the model? Why do we think that's not, rigging things to get the answer we want?
Laura, sorry,
Yes.
It's Giacomo. I have a question about the data that you buy. If you can go back, how did it affect the omega? So my question is, why the data you buy affects your information the same way the data you do produce?
Okay. So in this model, the theta, the thing we're trying to forecast, is the same for everybody.
Right. Okay.
So my data is about theta, your data is about theta, so they're interchangeable.
Right. Okay.
Yeah. I think that's a useful starting point. This is very much about like simplicity. I do think that the way we ought to think about it is that there are firms that have states that are correlated, and some firms are more correlated than others. So if I buy your data, it is not as good as my own data because it's about your state, which is not exactly equal to mine. It's imperfectly correlated. So
exactly.
we could put that in there. It's not going to change the simple forces that I'm outlining, but it would change predictions for other things we might want to use this model.
Right, and I would also like to make the opposite case, that is buying data that has been generated from someone else may add heterogeneity to some form that may give you better precision on some underlying state of the world that is common for everybody. So, so this may contribute to the growth part of the model.
Mm-hmm. Yes. Yeah, if we had a firm-specific shock that affected all of my data points, then getting your data could be more valuable because it comes with a different firm-specific shock. I think all of that is reasonable, and I think would be a great direction to go with this, is to think more richly about the structure of the data we have and how it differs across firms. Okay. So this is just kind of what you'd expect to get. When all firms grow together, the path of accumulation is concave. So the stock of knowledge, it grows quickly early on and it flattens out. Similarly, output grows quickly early on, it flattens out. That's just diminishing returns. We all know what that looks like, but I'm going to contrast it with what we see in a moment. So this is about all firms growing together, right? We were thinking of one representative firm in this market, and it's getting bigger. But when one firm, a small firm enters and everybody's at steady state, the dynamics are going to look quite different. So let's think about that next. So now we're doing a different exercise. We're thinking about a single firm I entering, but all the other firms in the economy are in steady state. Okay. So what can happen here? Here we can have convex data flows. And this goes back to this, this is about this data feedback loop. For a given firm, more data helps them operate at higher quality, helps them get more transactions, helps them get more data. That's a form of increasing returns. There's some convexity, and it shows up in a one firm problem. So the proposition is that there exist parameters alpha and p sufficiently low and a threshold omega hat such that when knowledge is scarce, so this convexity always kicks in when a firm lacks enough data or enough knowledge, that the net data flow, so the slope of this line increases over time. So that's about convexity. So what's going on in this? We've got our data outflows. That's just the same, whether we're talking about aggregate or a single firm, but we have our inflows, and the inflows now start flat and get steeper. So this dashed line is what is the data the firm produces. So that's what would be the net inflows to data if they didn't buy any data. The difference between the dashed line and the solid line is the data that they're buying. So if they couldn't buy data, or as Giacomo might say, if the data other firms have isn't relevant for them, right? If we shut down data markets, there's this possibility that this firm kind of gets stuck here in this low data trap, because they'd approach it and they wouldn't grow beyond it, and they'd actually just stay here. But with data purchases, it bumps them up, and it allows them to continue growing. In this example, right, we can construct other examples that have different things going on, but here's this possibility. So I would sort of want to highlight the fact that data markets help to alleviate this problem, but still you've got this convexity, even though the firm can buy more data. And part of that is about adjustment costs. Part of that is about the fact that this firm is still producing very little data, and so they're not accumulating as fast as they will appear when they're larger and have more transactions.
So without adjustment cost, you will just buy a lot of data and go up, no?
Yeah, it would look more like what would happen if you don't have an adjustment cost with capital. You would just buy a lot of capital and jump right to your steady state, assuming you don't have any restrictions on borrowing or something like that.
Yeah.
Right. But what happens here is that, so you've now got this knowledge stock for this one firm that's sort of this S shape. It starts slow and then ramps up, and its data purchases start slow and then ramp up. But what's interesting here is that the profits start negative, right? And so think about what increasing returns means. That sounds great. The more of it we get, the higher the returns. But it also means the less of it we have, the returns are really low. And so one might think about, like, we don't have any entry or something here, but to me that's suggestive of, if you put entry and exit and some, a more sophisticated firm dynamics, part in here, that you might get some entry deterrence. And those firms are choosing to produce, right? They have the option to effectively shut down by choosing capital investment equals zero, and they choose not to do it. And the reason that they choose to operate at zero profits is because this is an investment, a costly investment in a future data stock that will allow them to be profitable in the future. Okay, and so this brings us to the idea of data barter. So in this model, you could get a situation where a firm might actually give away goods at zero price. And in fact, we see that in reality. I don't have my cell phone right here, but otherwise I'd wave it at you and say there's lots of data being bartered on my cell phone. Why? Because there are a whole bunch of apps that I haven't paid any monetary price for. Somebody has paid to develop those apps. They weren't for free, and they didn't give it away for fun. They gave it away because in return for that app, that digital service, they are accessing the data that is transmitted by that digital service, right? So you get to use this app, but you're paying for it with your data at zero price. Well, that's a classic barter trade. Right? I am bartering my data for that app. So that would be like selling this good at a price equal to zero. And that data barter does happen early in a firm's life. So firms are willing to produce goods or a service, right? We could call that the app they're producing, at zero price. They're willing to give it away because the transactions generate data, and they're going to accumulate that data and use it to be more profitable in the future. Okay, so then the third piece of the result is the returns to specialization. So now we're talking about the long run, and we're talking about what happens to all firms in steady state. So who specializes in using data? So we're going to think about firms differing along one dimension, and that's this data mining ability, this Z thing, which mapped the number of data points and precision, it multiplied that. So if you're a high Z firm, you basically, for the same number of transactions, you're getting more inflow of data. You could think of it as multiplying the number of units, or you could think of it as multiplying the precision. Maybe you're just able to generate more precise data per transaction. So we're going to have some firms that are really good at that. They're going to be ZH firms, and some firms that are not so good at that data mining. Those are going to be ZL firms. And there'll be a measure lambda of the not so able firms and 1 minus lambda of these able firms. So we're going to define something called the knowledge gap. The knowledge gap is the equilibrium difference between the stock of knowledge of the high and the low data productivity firm. So omega was my stock of knowledge. This is for a high data productivity firm. This is the stock of knowledge of that low data productivity firm. And the difference is the knowledge gap. So proposition 6 is that when there's a single efficient data producer becomes better. So we take, one omega H guy and bump them up. Then that firm uses their additional knowledge to sell higher quality goods, right? So that's kind of what you'd expect. If I get better at producing data, I'm going to end up knowing more, and knowing more is going to make that knowledge gap bigger, more positive. However, when they're a measure of more efficient data extractors or processors, that become even better. So when that whole measure of the guys with ZH, the high data processing ability, get a higher ZH, they might specialize in selling more data. So this only happens for alpha, that's the Cobb-Douglas parameter sufficiently low, gamma, that's the price elasticity low, and that iota, that's about the how much of data you keep or you retain when you sell data, and not too many high data producers. Okay, so this only happens in a region of the parameter space, but you can get the high data productivity types to be less well informed than the low data productivity types. And what's happening here is that efficient data producers are going to specialize in the production of data, not the use of data. So the efficient data producers don't use the data, they sell the data to the low types. And the inefficient producers, they have a comparative advantage here, right? Everybody always has some comparative advantage, and their comparative advantage is in the production of high quality goods. So they specialize in the production of using data to produce high quality goods. And the high data mining types basically look like data intermediaries.
I think maybe I missed something here, but presumably these efficient data producers are getting the data from the low quality. I mean, they're not producing anything. They got to get the data from someplace. I take it that they're buying the data from these bad guys and then using it to sell the estimates. I don't quite figure out how it works. There's something I'm missing here.
Okay, so the efficient data producers, they're going to produce goods, but the goods they're going to produce are junk. They have really low quality. So they're going to do high volume, low value. And in doing that, they're going to generate lots and lots of data, but not a lot of economic value. And then
this is why Facebook is so awful. You've explained something that's puzzled me for a very long time. Okay, it all makes good sense.
Yeah. So Facebook isn't really interested in being a terribly socially valuable service. They're interested in getting a lot of people online and mining their data as well as they can, right? That's the business model. And they have a comparative advantage in doing that. They have no particular, they don't have a comparative advantage in producing any social value, and so they don't, right? So when data is either very private, meaning if I sell it to you, I have to give it up, or the costs of sharing are high, then the result flips, right? So if I can't sell, if I can't sell much, or if it becomes more costly for me to sell much, then the data efficient firms might also produce high quality goods, okay? So it's really important that when I sell data, that's kind of, when I sell data, I don't lose a lot of it, but then I end up selling so much of it that I'm left with less of it than the people that I sold the data to. Okay. So then the last thing I want to point out is, this kind of came up in the last back and forth with David, is that, some of these firms that are generating data, we do wonder whether they're actually producing some social good. And we could make this more general, like if data is using for advertising, maybe that's just business stealing, right? Maybe most of this prediction isn't really socially productive at all. We're just trying to beat out the other firm. I'm sure the truth is somewhere in between, but let's go to the other extreme and say, suppose data processing helps the firm that uses it, but it has no social value whatsoever. Okay, so could we represent that? Sure. So I'm gonna take a trick out of the book of Morris and Shin, 2002. This is their AER paper on the social value of public information, and I'm just going to add. So this is the firm quality, the good quality. That was A hat minus this squared forecast error. And I'm going to add the term in red. And what the term in red is it's a pure externality. So when my production technique is far away from the optimal technique, I do worse. But when everybody else's production technique is far away from their optimal production technique, I do better. That's a plus. Okay. So that's sort of like if they're better at advertising, or if they're worse at advertising, this term is bigger, I'm happier. If I'm worse at advertising, I lose. Okay. But what's important about this is notice that AIT, if this is a measure of firms and I'm measure 0 in that, in that continuum of firms, my actions don't affect this externality term at all. Right? It depends on what everybody else does, but not on what I do. So it doesn't show up in my first order condition. So it doesn't affect any of my actions. It simply affects welfare. So the same results as above would hold. We would still get diminishing returns. We would still get increasing returns. We would still get initial losses. We would still get data specialization and so forth. And because this doesn't affect anybody's choices. But what it would affect is the interpretation of what happens when we get more data, and is that a good thing for society, and does this sustain growth in terms of the value of goods overall. Here we would get, if I integrate over I over here and I integrate over I over here, I'll get the average good quality is always A hat. No matter what anybody does, no matter how much data we have, we would just have flat output. Okay, so I'm gonna conclude and say that big data here is information used for forecasting. And that generally gets us diminishing returns because once a forecast is really, really precise, getting another million data points to make it a little bit more precise and bring that variance a little closer to 0, it just doesn't do very much. And that's what, Bajari and Chernozukov and Hortaxi were writing about in that article I referenced earlier about Amazon. They were kind of documenting that Amazon for many forecasts has hit the period that, the point of severely diminishing returns, and they're not getting much out of the additional data that they collect. And so, I don't think we're near that point for the aggregate economy. I think there are a ton of firms out there that are not doing basic data-driven decision-making that could increase their productivity a lot. But this is about looking into the far future. And it's not even so much as a forecast. It's, these are the properties of data. And, we can accumulate so much of it that, like capital, it becomes less and less valuable. But data is not the same as capital. It also has some features of technology. So it's non-rival and it raises productivity. And there can be increasing returns at the firm level when knowledge is low, because the more data I have, the better I am at producing, the better I am at producing, the more customers I have, the more customers I have, the more data I have. That can make it very difficult for a new firm to get started in this loop. And you can get 0 prices and data barter and negative profits that could deter firm investment. And then finally, we talked about returns to specialization. So you can get people who are data hoarders, right? That was, if you're good at producing data, you hold on to it. But you could also get something that looks like a data platform. People who mostly, produce a whole lot of junk goods for the purpose of producing a ton of data and then sell as much of that data as they can. So this was a really simple set of assumptions. There are a lot of ways to enrich it that I think would make it more useful going forward. I think entire areas that to me now look wide open. Like, we've got a huge literature on asset pricing theory. We should really be thinking about data pricing theory. There are multiple ways we can talk about different ways one might go about that. But this is becoming an increasingly important asset in the modern economy. If our most valuable firms are valued largely for their data, we should have something more to say about what's the value of this stuff. And similarly, we could start thinking about data portfolio choice, right? We kind of know how to solve for, what you ought to invest in. If you know this, this, and that, you ought to buy this, this, and this. But what should you know, right? What data should you invest in? The way I'd think about that is that state data now should be a vector of risks, right? And we could produce data on this. We could produce this kind of good, which gets that kind of data, or we could produce this kind of good, which gets that kind of data. And we'd have this trade-off problem between various types of data or various risks to learn about. I alluded a lot to firm dynamics without really having any of the machinery to do that properly. So I certainly think we should think about entry and exit and imperfect competition and what this sort of increasing returns region means for market power and markups and such. And then lastly, I said at the beginning I was going to hold technology fixed. That's obviously wrong. So what do you do after solo? You do roamer, right? And so you put in endogenous growth, and you think about data as being an input into endogenous growth and ask what kinds of characteristics that economy might have. And so I think that's also a natural next step. All right, that's it.
You may think you're speaking, Ramon, but your microphone is muted. Ramon, I see your lips moving, but I don't hear you.
Sorry. I was saying just raise your hands and then I'll just give you the word. Okay. Let me ask you a question like everyone else raises their hands. Just a sec. I cannot see you now. Wait a second. So just following up exactly what you were saying now at the end, because now here, in Europe, we have with the recovery and all this funding from the Europeans, it's about digitalization. So should I think also like the public good aspect of improving the market for passing the information? There are two ways to think about going to endogenous growth or having an element of that. One is just simply do the Paul Romer thing, okay? And the other is think that about how this market for information acquisition and selling, it can be improved, like with G5 or whatever. Is that the way that you think one can go?
I'm not sure. What do you mean by improving the market?
Oh, I think that makes it much, much easier now to acquire information. Depends on the technologies we have. Okay. This passing on technology, it also depends on how we communicate.
Okay.
So I can have G5 or I can have many other things that will make it much easier for everyone to improve this buying, what is in your case, the market for buying and selling.
Yeah. Okay, so I mean, first thing is I think you want to take a stand on how socially valuable this is. If it was like the last model of just business stealing, then we're just fighting over slices of the pie and we should shut a lot of this stuff down. I don't really believe. I think there's some element to that, but let's move beyond that and take as given that some of this has some social value. I mean, I think there's good evidence that that technologies for improving the transmission of information have been absolutely fundamental in societies, developing. I'm thinking of like the advent of, paper versus parchment and, writing technologies that allowed communities to thrive. So I think, I want to think of this more like that. And then, I think, so you asked about the public good aspect. So certainly we could make it easier to find and exchange data. And that would be helpful. The other public good aspect that often comes up in growth models is the idea of information leakage. And that I think is a little bit different with data. If I think about like, what's the difference between ideas and data? Ideas are things or concepts that I can often keep in my head, like the idea of exchanging, letters of credit, or, the idea of, a chemical production process, or, the idea of this talk. Hopefully you'll remember some of it tomorrow, but, you might walk away having it embedded in human capital. Data, a lot of this stuff is like, what's my address? What's the price I paid? How many units did I buy? What did, that stuff's not easy to embed in your human capital and walk away with. We're not very wired to remember sequences of numbers, at least most of us aren't. And so I think that the idea of, ideas as public goods that's really salient in the literature on technology and growth might have less of a role to play in data and growth, because I don't think it leaks quite as easily, because it's not as easily embodiable as human capital.
Okay, David.
We're well beyond what I actually know or could prove. Okay, I think David wants to weigh in on this, but now you're muted.
Sorry, I need to turn my microphone on now, otherwise nobody will hear me. No, I wanted to say, actually, despite my earlier complaints, I thought the paper was very clean. I mean, I anticipated after you explained that actually it was like investment, that something like what you showed would be true. But I must say, the devil's in the details. I'm actually very struck by the fact that you were able to produce such a clean model, to give such a simple, that we got back to, the typical growth diagram, and together with the sale of the information. So I was actually going to ask you a completely different question, totally unrelated to the talk, since I really didn't have much more to ask about the talk, except I can't see you anymore. You had a logo behind your head while you're, there you are. It says your name, and then it says she, her, hers. And I'm just wondering if you briefly explained the logo, that's all.
This is Columbia Business School standard, so that if you prefer pronouns other than she or him or whatever, that you can put in whatever pronouns you like and everybody knows. But this was automatically generated for me by Columbia. I like to use some background.
Just curious.
Yeah, if you want to be like they, zay, zer, whatever, you can
put it in. Okay. Gosh.
You didn't know how you wanted to be called. Anyway, this was not my statement.
I mean, this would have been my presumption, so I'm glad to say I'm correct that that's what you'd like to be called.
Yes, that is what I think you're called. Thank you. Yeah. Any other questions about growth, data, or anything else?
Yes.
I don't hear you, Zena.
Can you hear me?
Now I hear you, yes.
Okay, perfect. So my question was that what if for these data that we were talking about, another dimension of information realizes? So for example, taking the example of Facebook. So initially they were thinking that the data that they had could only be used for advertising. But then they realized that they can sell it for political campaigns or for other sort of uses. So, I mean, the information or the I don't know, marginal product of the data now is like suddenly changes, and then would that translate just simply into like the kind of example that you gave, that we would have like a convexity in the inflow, or you think it should be like a different sort of analysis?
I think the way I interpret the kind of changes you're talking about is these are ideas. These are, in a way, I mean, we don't normally think of politics as a technology, but if we're finding new applications for existing inputs that increase their marginal value, that's technological progress. So I might put it in the, in the Z, if a given firm realized that their data has new applications, maybe that data has now become more valuable or more productive to that firm. I could think about there being multiple production processes. So now instead of one good, we've got a couple of them, and all of a sudden we discover a way to feed data into one of those production processes where we couldn't before. But these are the kinds of technological changes that I wanted to hold fixed to start with, because I think there are a lot of different ways to think about data technology. I think data is an input into the discovery of classic technologies, right? We all use data to test theories and advance knowledge, and that's one way to think about it. But at the same time, there are technologies that have changed how we use data itself, right? And that's a different dimension of technological progress. And then you've mentioned a third, which is, not just how we turn data into knowledge, but the kinds of things that knowledge is used for, right? We've become, more adept at using data-driven decision-making in different domains. And so all of these are different ways of putting technological progress in the model. And, I think all of these are interesting, and hopefully this gives you kind of a platform in which you could, that's simple enough that you could build all these kinds of different dimensions on.
Yep.
Are there any other questions?
Ramon seems to be not having his microphone on. He's in charge.
Oh, yes. I just don't want to have too much echo. So I was saying any other question.
I do actually have a second question.
David?
So we have a few minutes, otherwise I wouldn't ask this. This may be something that I missed, but you had a diagram which was the growth theory diagram with the line that wasn't quite straight and the curve that intersected it. Yeah. And then you had the diagram where you did it, where you sale of information. And you asserted that if all the firms except for, I believe, if all the firms except for one were at the steady state, that the remaining firm would have a tangency at a low trap point. And what wasn't clear, what wasn't clear to me was why that, okay, but it has to be a tangency. It can't go below or not? I just wasn't clear.
It can go below.
It could go below. Okay, I see. Okay.
I was just trying to point out for that example that whether or not they bought data or
right.
couldn't buy data would make a big difference for the trajectory of this firm. But that was a particular numerical example. It absolutely can go below. It doesn't have to
right.
be. It could be below. It could be above. Any of these things can.
So just to clarify, so in particular, if it went below, then a small amount of data sales wouldn't bail them out. They'd still be stuck. Okay, it makes the trap less likely. Okay, thanks.
Yeah, that's right.
Okay.
Yeah, that was very much in the spirit of it's a possibility result.
Okay.
So we can construct a possible case that's interesting. We might think things like that happen. Here's a way to think about it, but it's absolutely not this happens, or even for ranges of parameters.
Right.
That's
I think a fair conclusion from the diagram, if it's less, is that it is less likely to happen in some sense if there is data sales.
That's right.
So if it wasn't happening in the first place, it wouldn't matter. If it was happening and there's enough data sales, then it would bail them out. So I mean, I'm happy with that. It just wasn't clear to me whether this was a ubiquitous thing, they're always tangent, or it was just sometimes.
No,
okay.
Not ubiquitous, thanks. Just illustrating the possibility.
Thanks.
It is true that data sales will make the curve less convex.
Right. Well, if you're saying something, you didn't turn your microphone on again.
I was just saying that you have a bonus to come, okay? So, it was a great lecture. I mean, having you all live will have been even better. I mean, I've seen like when you gave the lecture at the SCD, I mean, that was absolutely great too. So I think that you're doing wonderfully. So thanks, and let's be in touch. Okay, so now you can just...
You can unmute your microphones. Thanks.
Thank you, everyone.
Thanks a lot.
Pleasure. Well,
bye.
Bye.